Hey there, my name is Hitesh and I welcome you all to YouTube channel of Trade Brains. If you haven't yet subscribed, please click on the subscribe button and also press the notification icon. Now in today's video, we're going to be discussing two important strategies which are commonly used and sometimes used so often that people end up using it in the wrong way. And I'm talking about the strategies of straddle and strangle. These are the two commonly used option trading strategy and they have advantages both for the buyers and sellers. Will try to understand that, and we'll also understand the application of those strategy via payoff chart, which I'll be sharing on my laptop, and we'll show you how the payoff changes as and when the price of underlying asset moves. So I can't wait to begin. So let us begin our discussion on that. Now the first strategy which I'll be talking about is called the straddle. Now before talking about the concept of straddle, I hope you know the concept of in the money, at the money, and out of money. And if you're not aware, just a small brief. So in the money options are those options which would make money right now if you were to exercise them immediately. Just to give you an example, say if the spot price of Nifty is 19,800. So all the strike prices for all call options which are below it, say 19,750, 19,700, anything below it becomes in the money, and all the strike prices above it become out of money for call options. So how does it work for put options? In case of put option, all the strike prices which are above the spot price, say 19,800 being the spot price, so the strike price of 19,850, 19,900, 20,000, all those strike prices are in the money for put options. And similarly, all the strike prices below it, say 19,750, 19,700, everything below it become out of money for put options. That is about out of money and in the money. So what is at the money? At the money strike price is that strike price which is closest to the spot price. Say if the spot price of Nifty is say 19,790. So what will be the closest strike price? That would be 19,800. So 19,800 strike price becomes at the money for both call options and put options. That is in brief about moneyness, that is in the money, at the money, and out of money. Now coming back to our discussion of straddle. Now straddle is that option strategy that involves at the money contract. So here in this case, what happens if you are looking to go for long straddle, which means if you are looking to buy options, then you buy at the money call option and at the money put option. That is a simple technicality of straddle. If you're looking to go long, you buy at the money call option and at the money put option. Similarly, if you're looking to be the seller of straddle, then you sell at the money call option and at the money put option. That is a simple definition for both long straddle and short straddle. Just a small recap: long straddle, you buy at the money call option, put option, and for short straddle, you sell at the money call option and at the money put option. That is about straddle. So what exactly is strangle? How is it different? So in case of strangles, you use out of money contracts. Now basically, as I told you, in straddle you go for at the money. Now in case of a strangle, say if you are going for long strangle, and you which means you're expecting a good move or a big move in the market, and I'm talking on moves in tune of 2%, 3%, or sometimes more. So then what you do, you go out of money and you buy call option, and you go out of money, you are buying put option. Here in this case, you're not sure of the direction of the move, but you're expecting an exaggerated move in the market. In that case, you go for long strangle. And similarly, when you go for a short strangle, when you're expecting small movements and not exaggerated movements. So in that case, you write out of money call option and also you write out of money put option. You try to pocket the premium for both of them and you try to benefit from them. So that is the simple definition of straddles and strangle. In case of straddle, you go for at the money contracts. If you're going for long straddle, you buy at the money call option, at the money put option. And if you're going for short straddle, you sell at the money option, that is call option and put option. Now if you were to focus on my screen, I have taken to the website of opstra.defineedge.com. This is not a promotion. This is a platform which I use generally for the purpose of testing out strategies. So we'll go to options builder, that is a strategy builder here. And we are looking to build a strategy of straddle first. So we'll have to take two at the money strike prices. Now, if you look at it, the spot price is around 19,969. So which means 19,950 becomes your at the money strike prices. So we'll choose options. We'll take this month and expiry, that is the 27th. And we'll choose the expiry of say 19,950 as we have found that to be at the money. And so we buy one call option and again we buy one put option. This I'm talking from the perspective of buying a straddle, and we have added the position. Now if we were to go down, you can see the payoff chart here. Now, if you look at the chart here, in between the range, it's showing red, which means if the market stays within the range, you can expect not to make money. But if the market goes or trends in any direction, you can expect a bigger movement. Let us understand a little bit more about it. The break-even point. Now, break-even points are those points beyond which if the market drifts either side, you make money. So in our case would be 19,716 or 20,184. How do we reach to that point? Basically, this is the amount of premium which you have paid to be able to enter in the straddle, and the strike price you add and subtract from either side, you get the break-even zone. So if the market stays within the zone, you're obviously going to lose money because you have paid premium. But if the market takes a trend in line of your expectation, you buy a straddle when you're expecting the market to move in certain direction. So if the market goes up and goes up beyond the level of 20,184, you make money in this trade. Or comes down to the level of 19,716, you make money in this trade. So if you are a long straddle holder, you make money only if the market drifts in certain direction. Now let us modify the strategy and look at from the seller's perspective. The seller's payoff chart would be the exact opposite of buyer's payoff chart. Now again, you go to this edit option here, you make the buy to sell and you just modify. That is as simple as that. In the second leg also, you go to edit, you make the buy to sell and you modify that. Now you guys, I told you the payoff chart will look exactly opposite to that. So the seller here wants the market to get stuck in a range. Even if it drifts little bit, 0.5% here and there, and stays in that range. In that case, he'll make money. He makes the best money if the market were to expire at 19,955, because that is at the money strike price. That's his maximum profit which he can make out of it. If the market breaks out on the either side of break-even zone, is when he'll start to lose real money. So you can understand till that point when the buyers make money, the seller loses, and the moment seller starts making money, the buyers start losing the money. Now the margin required to ride the straddle or sell the straddle is slightly high. It's about 1,35,425 rupees, all of which can be seen here on the chart. The maximum profit again is 11,725 when you are writing the strategy. So that is about the payoff chart if you are doing straddle. Now let us move to strangle and find out how does the payoff chart look for that. For that, I'll remove this existing legs because we have to see for strangle now. So we are again back at the main page of this place where I'm doing the strategy building. Again, you go for options, take the last expiry because it will have some premium to show and we can easily explain it better. You now have to go at least 2 strike price above and 2 strike price below if you're looking to buy a strangle. So in this case would be, we'll go for a strike price of 20,050 and we will buy a call option there. Remember, we have to get out of money for both and we add position. Similarly, we go 2 strike prices below the at the money strike price, which in our case would be 19,850, and you buy a put option, you add that position. Now that is how a payoff chart looks if you are a buyer of a strangle. Now what are the most important things you see here? For starters, the margin required here is only 7,450, which in case of a straddle was 11,500. Why is it more? Because in that case it was at the money. In this case it is out of money. So out of money is always slightly lesser expensive, but it has its own flip side. Flip side is that the break-even point in this case is 19,701. Either market comes below that or goes above the level of 20,199, as you can see here. So if you want to pay less margin, then you would obviously have to be taking a hit towards the break-even points. So that is the whole mechanics of straddle and strangle. The maximum loss gets predefined if you are a buyer of a strangle because you have paid premium, and the maximum loss is always not more than the premium which you have paid. Now let us look at from the seller's perspective. From the seller's perspective, we modify the strategy and make the buy a sell. We do the same thing for the other leg. We again make the second leg from buy to sell. We modify and we get a payoff chart. As again expected, the payoff chart is exactly opposite what it looked for a buyer. For a seller, he actually wants the market to stuck in a range. He doesn't want the market to drift away. If it drifts away, he loses money. He ideally would want the market to stay within the break-even zone and more closer to at the money strike prices, because that is where he'll eat up all the premium. So if the market stays within the range of 19,701 or 20,199, that is this 500 point territory, he's set to make money. So strangle writers obviously want to go as far out of money as possible, because why? It gives them bigger room to play with it. So that is how a payoff works. Now again, for a seller of a strangle, the margin is on the higher side, about 1,30,000. Why the margin is higher for seller? Because we all know that sellers are exposed to unlimited risk. The market can drift to any extent. So to compensate that for the big risk, the exchange and the broker keeps higher margin or the span margin from the seller. So this is how a payoff chart looks. So I hope you have understood. For both buyers of straddle and strangles, they would want the market to drift so they make money. But for writers of straddle and strangle, they would want the market to get stuck in a range. So this is how a payoff chart looks like. So now, having understood the payoff for both straddle and strangle, understand what are the major points or difference between both the strategy and in what kind of market should you use either straddle or strangle. Now coming to straddle. Now straddle is generally used for the buyer by the buyers when they are expecting a major move in the market and they are okay to pay a slightly higher premium. Why? Because at the money contracts are slightly more expensive. And straddles are used by sellers, that is they write both at the money call option, put option to sell a straddle when they're expecting market not to drift majorly and stuck in a range. Now how does it benefit them? They get higher premium. To buy a straddle you pay higher premium, which means the seller will also receive a higher premium. Now, if we were to talk about strangles, strangles are used by buyers when they're expecting exaggerated movement, sometimes 2, 3, 4%. They want to capture that move, but they don't want to pay high premium at the money contracts, so they go for out of money contracts. On the other hand, strangles are used by the sellers when they're expecting market to move a bit, but they're not expecting exaggerated movements. So to cushion themselves from this movement, they go for slightly out of money writing. But the flip side is that they get little lesser premium when they are writing strangle. So we understood depending on the market situation you use straddle or strangle. Now let us understand what are the major points of difference between the two strategies. For starters, in case of straddle, you buy at the money contracts, or when you're writing, you write at the money contracts. Similarly for strangle, if you are a buyer, you buy out of money contracts, and if you're a seller, you write out of money contracts. In case of a straddle, the amount of premium required is higher because you're buying at the money contracts, which come expensive. Similarly, in case of a strangle, the amount of premium required is slightly lesser because you're going out of money, but that comes with a disadvantage. The straddle buyers have a higher profit potential as against the strangle buyers. In case of a straddle, the probability of profit for a buyer is slightly higher because they're closer to the market and the strike prices are closer to the market. But in case of a strangle, the probability of profit lowers a bit because you're going slightly out of money and your break-even point widens. As you saw from the payoff chart also, the break-even point in case of a straddle was closer as compared to the break-even point in case of a strangle. And on the flip side, if you look at the seller's perspective, they would actually want a wider break-even point. So a lot of sellers prefer writing strangles as against writing straddles. You basically enter into a straddle agreement, that is from the buyer's side. Then you're expecting a volatility, but the volatility, even if it's lesser also, it can still make money for the buyers. But when you are buying a strangle, you have to be expecting a high volatility in the market for you to be able to make money. So this was the major points of difference, and this is what straddle and strangle is all about. We understood what are straddle strangles, what kind of markets to use. The payoff chart we saw on the screen, how do they make money for both buyers and sellers. And in the end, we wrapped it up by understanding the major difference between the two strategy. I hope you learned something out of it. And if you like the content, please like it and do share it with your friends and family. Again, thank you for your patient hearing. I'll again see you next videos where we just learn and discuss something new about financial market. See you then.